Is there a crisis brewing in the repo market? And what in the world is happening to the gold price? Let's get into a global macro update. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. The repo market is starting to catch our attention, but more so the gold market. The gold price is approaching $4,300, an insane move in gold. Now, I'm going to start right by saying I don't know what's happening in gold, but it is certainly scaring me. So today we're going to go through what's happening in the repo market, what could be happening in gold, and think about the Fed. Now the Fed is back in play. So let's start today with the repo market. Viewers will be familiar with this chart. This is the Fed's policy rate corridor. We call it a corridor because the Fed doesn't set repo rates. It doesn't set a specific rate at which repo transactions must occur. It sets ceilings and floors. These are policy rates that the Fed has in order to help keep the repo rate inside that corridor. And in that way, it has a target for where it wants repo rates to be, not an actual rate. Now, let me just say one thing before we get into this corridor, which is that we know the Fed's policy rate target to be the Fed funds rate. That is the rate that is often cited in financial media in terms of where the Fed is moving around policy rates. Now, in today's world, the Fed funds rate is not the rate that matters. It's just one of the interest rates inside the money market that does contribute to the overall financial plumbing. However, the most important rate is the repo rate. This is the rate at which banks borrow against their own treasury collateral. They borrow funds, they post treasury collateral, and they pay a repo rate on the funds that they borrow. It's an overnight interest rate, and that overnight interest rate represents the wholesale financing rate in the market. The Fed wants the repo rate to be inside its corridor. And now when you look at this chart, we have a black line, which is general collateral. This is a general repo rate, but I want you to focus in on the orange rate, which is SOFR. This is the repo rate averaged. So what is the average repo rate in the market that the Fed is using to measure if it's being successful in keeping rates within the corridor? Now, let me just say here something about the red line and the blue line on the top and the bottom of the corridor. These are rates that the Fed uses to force repo rates inside the corridor. The red line is the discount rate. There's another rate in here called the standing repo facility rate. We're going to talk about that here in a few minutes. That's a very important part to today's conversation. But this red line, it's a rate that the banks can go to the Fed and say, hey, we want to borrow here. Here's some collateral. So why would a bank borrow at a collateralized rate above the red line? The Fed is assuming that the market will not do that the banks will not do that. And in that way, it's trying to force through arbitrage rates inside the corridor. But you can see here that today at 4.29, this rate is above the discount rate. That means that repo market transactions, were getting done at yields above the Fed's ceiling rate. It means a couple things. Number one, the ceiling isn't explicitly effective. It might be somewhat effective, but it clearly is not explicitly effective. It did not keep SOFR rates, treasury repo rates, from rising above it last night. The second thing to observe here is that SOFR rates have not risen above the corridor throughout this cutting cycle. And so that is material. I want to now bring in the other side of the story. What could have happened last night in the repo market? Today we are recording on Thursday, October 16th. The block height is 919,357, and the Bitcoin price has fallen below $109,000 here on some broad risk market jitters. So what is going on? We're going to keep unpacking what's going on in the markets, but I want to stay here in the repo market because that is the world that we come from at the Bitcoin layer. It's a repo trading desk, and in that way we're able to understand the financial plumbing and what might be happening throughout the rest of the system. All right, I want to let you guys know about another great Unchained event that is taking place online October 28th with Mark Moss and Jeff Andrew. They will explain to you why the 401k system is not meant to serve you, but meant to serve an entire fee structure. And they will teach you why Bitcoin scarcity make it the perfect asset for a retirement portfolio and some of the regulations around Bitcoin in retirement and how you can get that Bitcoin into some of these tax-advantaged retirement portfolios. Register now at unchained.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archlending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. Blockstream, where the future of finance runs on Bitcoin. Go to store.blockstream.com and use code TBL for 10% off. Pick up a Jade Plus hardware wallet. It integrates seamlessly with your Blockstream app, and it's the perfect way for both pros and beginners of Bitcoin to get started with your cold storage. Store.blockstream.com, use code TBL for 10% off. Now let's zoom in a little bit closer at that 4.29 rate that we just discussed in the last chart. This chart is the spread between SOFR and IORB, and the spread is now at 14 basis points, definitely at the highest level it's been this year, and in a trend upward that might not have to do with the calendar, and we'll get into the calendar here shortly. Now the green line, IORB, this stands for interest on reserve balances. So who is using IORB? It's large banks. So let's say JP Morgan, for example. JP Morgan has $1 trillion in reserves, which are funds that are deposited at the Fed. On those reserve balances, JP Morgan is making a 4.15% interest rate on an overnight basis. So a good way to think about how much that actually is, you take 4.15 and you divide it by 360. We'll do that right here. And what you get is the daily interest rate. What is the bank making on an overnight basis? Now I'll divide it by 365 just because to be a little bit more accurate. They're making 1.14 basis points on their reserve balances every night, right? So about 1% every 3 months and about 4% every year, right? So 4.15% is the annualized rate. But these are overnight rates. That's why I divide it by 365, just to give you guys a sense of what's happening in the micro. Now, JP Morgan has these reserve balances. They're making 4.15% annualized rate, meaning they're only making 1.1 basis points on that balance for tonight. Now they go into the market and there's a repo participant that says, hey, JP Morgan, will you lend me your reserves tonight? I will pay you 4.16% annualized rate. JP Morgan says, no, thank you. I'm okay to just leave my money at the Fed. I don't care that I will get 1 basis point more divided by 365 because it's not material to me. Then the participant says, okay, what if I borrow from you at 4.2? No, thank you. 4.25? No, thank you. How about 4.29? And JP Morgan says, okay. What that means is now go down to the bottom pane, that red number. What that means is that JP Morgan is waiting for 14 basis points above their reserve balance rate to take reserves out and send them to their neighbor bank. So why would JP Morgan not do it at 5 basis points, not do it at 10, but wait till 14? That comes down to reserve scarcity. Is there a crisis going on in the repo market? That's what we want to know, and that's what we are asking today. Well, there is one explanation here as to why this is not a crisis, and that comes back to the calendar. Now, if you have been watching this show for a while, you know that the calendar has an effect on the repo market. Just look at the middle of this chart on the bottom pane. That spike around the end of 2024, you see at the end of December, this rate spikes up and it stays elevated for a little bit. What's going on there? This is the repo market struggling to get past year end. Now, if you have all this treasury collateral and you need to borrow money to make sure that your balance sheet is set for December 31st for all the regulatory strikes, you have to be a fully funded bank. It means you can't have any offsetting repo positions or imbalanced repo positions. Everything has to be funded. And so you are going to do everything you can to get that funding over the December 31st turn because you don't want to be scrambling for funds on December 30th or December 31st. You want to get done before. So repo rates will rise into the end of the year because of the calendar, because of balance sheet strikes, and which are basically for regulatory purposes. So this is for regulation, for the books, for the shareholders. Everything must look clean at the end of the year. Therefore, repo market rates must rise in the face of all the repo market borrowers, meaning all those that need to borrow funds. They need to be able to borrow those funds that they will pay up. That's why the rate rises. They will do anything. They will pay higher and higher rates just to make sure that they are clean for their balance sheet. So why is it happening on October 15th? Well, people might remember the repo crisis from 2019. When did it start? It started on September 15th, 2019. What was significant about the 15th? And actually the 17th was when that crisis got going because of a weekend issue here where I believe that the 15th was either on a Friday or a Saturday, so that 17th was the day where repo market rates really got going. What was going on in the middle of September during 2019? Well, just as any September 15th, this was the corporate tax deadline. Now, if funds that are usually funding the repo market on an overnight basis get taken out of those repo money market funds and sent to the government for the tax payment on September 15th, there might be a shortage of funds on September 15th every year. And that's something that we looked for on September 15th this year. And yeah, we saw a little bit of a increase in repo rates, and people chalked it up to a mid-month turn or this corporate tax day. Now, what happened October 15th? Well, people are attributing this once again to perhaps a mid-month turn. So what was going on? Well, there are a couple things. The repo market does have roll schedules on a daily, weekly, mid-month, and month-end. And so at any time, there can be rollover dynamics that are entering the market. Yesterday was also a tax deadline for some of the people that were affected by California fires. So are California residents that are paying taxes on October 15th enough to withdraw reserves so that they're so scarce it would spike repo rates to 14 basis points? I'm not sure. Is it possible that this 14 basis point spread of SOFR to IORB is something that we should get used to in the middle of the month now, or at the end of the month, that we're going to have these higher repo rates structurally and higher repo spreads? I don't know. And I would honestly fade that narrative. I would fade it pretty hard, meaning I believe you are entering reserve scarcity right now. It's right in front of your eyes. What is one of the things that I've been writing about for a couple years with QT? Eventually, QT will have to stop and reverse on a sheer GDP basis, meaning that as GDP rises at 6 to 7% nominally every year, the amount of reserves in the system that you need, the quantity of reserves, has to expand. There are a couple things there. And the most important part of this is the amount of treasuries in the market. Treasuries in the market, if they are growing and growing in quantity, which we know there's so many treasury bills being issued right now, those bills have to be funded in the repo market to be absorbed by the banking system and the money market fund complex. If the repo market cannot fund those bills, you have a funding crisis. It happens really quickly. Oh my God, all of a sudden, there's another 100 billion in bills that need to be financed in the repo market, and there's not another 100 billion in the money market funds that can just pour over into the repo market. So where do we go? Knock, knock, Jamie Dimon. We call up JP Morgan and we say, hey, will you lend me your reserves, Jamie, tonight? And Jamie says, no. Why, Jamie, won't you lend me your reserves? And Jamie says, because I don't think that there are enough. I want to keep my reserves. I will need them for interbank payments. I will need them to buy bills for JP Morgan's balance sheet. And if JP Morgan is not lending its reserves, what happens? This red line goes up. The repo spread goes up to reserve balances. You have to think of this red line, this 14 basis point spread, as when will Jamie answer the phone and say, yes, you can borrow my reserves? If it keeps going higher, it means that JP Morgan is not lending that marginal reserve. And that means, boom, reserve scarcity is back in the market. Now, what must the Fed do? What have I been saying? They will expand reserves in line with nominal GDP growth. Does that mean QE? Well, by name, it might not, but by the function of permanent open market operations, a steady growth in the quantity of treasuries held by the Fed, I believe, yes, quantitative easing is coming back. They won't name it that because it's not technically an easing program. It's a growth in reserves in line with the needs of the money market. So what will they call it? I don't know. But is this a repo market crisis? Without calling it a crisis, this is a problem. And the Fed, you bet that the Fed is watching this very, very closely. We've had Eric Wallerstein on the program. Now, Eric, who is a fantastic repo analyst, Eric was trading the repo desk at the New York Fed before he went to work at Yardeni Research, and then was poached by Dr. Stephen Myron, another guest of the program, who's now at the Fed, formerly with the White House's Council of Economic Advisors. Now, Wallerstein, who now works for Myron at the Fed, told us on this program last year how closely the New York Fed watches this SOFR rate, not just on a daily basis, guys, but as the transactions actually hit the tape on Bloomberg. Where are Treasury repo deals getting done in size? They know to the basis point, maybe to the 1/10 of a basis point, where these repo market rates are. They are definitely aware of any blip in the repo market. They are quick to defend a potential repo market crisis. And I would suggest here that if you don't get a quieting down in the SOFR market, in this spread particularly, if you don't get a quieting down over the next few days, you are going to see headlines, trial balloons, QE, QT type of headlines come across from Fed speakers. It's going to happen very quickly. The market will adjust. This is something that we need to be watching very, very closely. Now let's pull some of these larger numbers together for you to give you a little bit more context for the repo market. The red line is reverse repo. Now this can be thought of as excess reserves. These are funds that can go into the SOFR market and basically defend SOFR from rising. Now it's zeroed out. So you don't have any reverse repo balance to come in and knock those SOFR rates down relative to IORB because there's no excess. That red line, those were money market funds that have their money at the Fed overnight. Well, if a market participant comes in and says, hey, I want to borrow some of those funds, I'll borrow from a couple basis points above the Fed, those funds will go there. But they're not going there. They are completely depleted. So that red line, reverse repo, it's gone. The black line are money market fund assets. This is the pool of assets from which the repo market is funded on an overnight basis. You can see it's large, $7.4 trillion. But there are a lot of bills out there, $6.4 trillion in bills. Those bills have to be funded. Now, the purple line is your SOFR usage. That means that on a nightly basis, $3.06 trillion of U.S. treasuries are funded in the repo market. That's why the SOFR rate is going up, because there are so many treasuries that need to be funded. Now, I can show you the $7.4 trillion in assets that are the basically the pool from which the 3.06 million are funded. But if that 3 million number keeps going higher and the bill number keeps going higher, that 6.4 trillion number keeps going higher, which it is, it means that the $7.4 trillion is only enough to fund XYZ, but not enough to fund the entire repo market, thus SOFR rates popping up above normal spread levels that we're used to. So this gives you an idea of what's going on. Now, let's actually take it all the way to the stock market and Bitcoin for a second. What happens when there's a spike in repo rates? When there's a spike in repo rates, it means that collateral that needs to be funded gets funded. It gets funded at a higher rate than it did last night. So that means that the funds that are now funding repo at a higher rate, they came out of something. And that's where you've seen the chain reaction, that it had to come out of something else. And what was that something else? It was something that was marginally more risky than a treasury repo. And so that's the risk spectrum that we're talking about. And as the repo market experiences tightness, money gets pulled from other sources to then capture that risk-free yield, because it is a risk-free yield. You're lending against treasury collateral, which can be liquidated and sold on the spot. It doesn't have the same risk profile as a security that can default. And so if the yield on the SOFR instrument is just as high as something risky, the money comes out of the risk asset and goes into the treasury market. And that's why you might see risk markets suffer if you have a repo crisis. It's a chain reaction, but they are related. Now, here's one more angle to the repo market that has us watching it very closely. The standing repo facility. This is a facility that isn't very much used. It's an emergency facility that was put in response to that September 2019 repo crisis that we just discussed. That standing repo facility is a way for the Fed to say, hey, if you can't find a repo counterparty, just come to us, we got you. And you can see that zero usage for basically the last several years. And now it's popping off of zero, You have 6.75 billion in usage a couple nights ago, and this was up to just above 8 billion on a nightly basis yesterday. So 8 billion, not that much, but the fact that it's being used is a big deal and something that we cannot ignore. When we understand how the repo market works, the fact that anybody is calling the Fed and saying, hey, I need you tonight for the repo facility, that is a problem. Now, I am not the one to just rush and call things a crisis, but I can tell you a problem when I see it in the repo market, and we currently have a problem. Before we leave, we have to talk about gold. I was talking to the team today, and I was telling them, look at the gold chart, and Damien asked me, he goes, what's happening with gold? And why are you scared by it? The reason that I'm scared by the gold price action is that I can't explain it. When yields collapse and treasuries are skyrocketing in price, I know what's happening. I've seen it many times in my career. When the stock market crashes, I know what's happening. When the repo market starts to dysfunction, I know what's happening. I've experienced these things before. The gold price right now is nothing that I've ever seen and nothing that I can explain. It feels like a massive short squeeze, which begs the question, well, who is so short and who is getting squeezed? There are other analysts out there and other shows that will do a better job at getting into some of the reasons for this market move. Some of them come with an extremely heavy amount of speculation because there isn't a lot of data from which to base a thesis on, other than looking at all the information that we have and connecting the dots. And so I appreciate people that are connecting those dots and trying to speculate as to what is happening in gold. But I present to you here the monthly candles on gold, and you can see that what has happened in September and October of this year is without precedent. This is not something that anybody has experienced before. These types of moves, at least on a nominal basis. Now, there were moves during the 70s and then 80s after the gold price peaked and then crashed back down, when the volatility could maybe be compared to today. Now, what happened in 1973? Well, you had currencies float against each other for the first time after the gold window closed in 1971. So what is happening today? If it's not the gold window closing that's causing this type of price action, it's something else. Gold trading at $4,290 today. It is a move that makes me very worried as to what the cause of it is. Now, when I look at the other markets, such as the treasury market, I see yields falling in the 2-year sector. They are now on the lows at about 3.45%. Bitcoin trading quite poorly on a spike in volatility, and 10-year yields back down to 4%. I don't necessarily see a crisis in yields or in stocks, but I see one in gold, and I see trouble in the repo market. My message to everybody at home today would be to expect volatility, to watch the repo market closely. I would always watch treasury yields to see if they're falling. If treasury yields fall below 4% in the 10-year and then start accelerating to the downside, that would be another red flag that something is going on that's quite dangerous. The repo market, of course, but watching this gold market go where it's going is something geopolitical and not really traditional market related. That's why, by the way, that I don't have a great visibility into what's happening in gold, is that it's not a traditional asset, and its price moves they're usually not attributed to things that are going on in traditional markets. Therefore, it's geopolitical in nature what's happening in gold. I firmly believe that. It's scary to look at this price and think who might be on the losing side of this trade and why that person, entity, country is getting liquidated in the way that they are or being squeezed in the way that they are. And it's just going to be something that we're going to have to follow up. Thanks for sticking with us today at the Bitcoin Layer. Go to thebitcoinlayer.com/subscribe to become a TBL Pro, gain access to our proprietary metrics. We'll catch you guys next time.